Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, I'm Dong Jackson, Tony. Now let's start today's group art session. Good evening. So even though today is Friday, I think maybe everyone feels a bit different compared to other Fridays, maybe a little down. Of course, yesterday, before the market opened, things were looking pretty good here. But then when I woke up this morning, I was almost... As soon as I woke up and checked my phone this morning, honestly, I was planning to stay in bed a bit longer, but then things just went downhill right away. How could things change so drastically? Let's take a look at that today, because, well, some people have brought up concerns. There are questions in the market about Huida's accounts receivable. All right, so it's pretty simple. We'll just take a quick look, not super detailed, just a general overview, because after all, we can't really go into that much detail. So let's talk about their financial report. When we talk about it, we're speaking in theoretical terms. Now, account receivable, that's what we call 应收账款. When you mention accounts receivable, the standard reaction in Taiwan is usually to tell you, look at inventory, huh? The days sales outstanding for accounts receivable, the inventory turnover days, and the days payable outstanding, right? Of course, here we're just looking at some of the changes, more or less. We check accounts receivable, look at inventory, and then take a look at the cash flow to see if there are any issues. In the market, this is basically the only thing people question. The issue of AR being too high, let's take a look at where the problem actually is. Is the problem really as serious as everyone says? And then the employment data is still pretty messy. So today we still need to spend some time talking about it. And then the Fed's message is really loud and clear. But still, let's look at when the biggest pressure point might come and when things might start to shift. In fact, if you calm down and look a bit further ahead, it might actually be different from what you think. So let's take a look. This is something I saw this morning. Later I searched and it seems like it was on the US TV news. NVIDIA's financial report showed a big increase in accounts receivable and the market reacted quickly. So it went up, first rising by 5% and then reversing and falling. So actually on the candlestick chart, this is a pretty big move. Looking for the reason afterward, to be honest, people usually only look for the reason after a big drop. So what we found here is that accounts receivable increased significantly. But if we look at their accounts receivable, that's right. It went from $23,065 million to about $33,391 million. If sales were really that good, then why hasn't the payment been received yet? Actually, if we take a closer look, saying it like that isn't really fair. You'll see what I mean in a moment. Also, there are customers who haven't started launching new AI startups yet, so it might seem like there are definitely some issues here, but let me tell you, it's the same for any business we run. To some extent, you have to take on certain risks. As for whether the risk is high or low, I think these big companies are all very clear about this, and we more or less know it too. First, let's take a look at the amount of accounts receivable. Okay, when we compare it here, it's not really a lot, but it's not a little either. We've listed the figures for 8 quarters, starting from fiscal year, which is the 4th quarter of 2024. So let me talk about that first. NVIDIA's 4th quarter ends in January, which is different from everyone else. Their quarters are February, May, August, and November. February, May, August, and November, that's their quarterly cycle. Sorry, I got a bit mixed up. So it's February, May, August, and November for their quarters. So their cycle is different from what most people are familiar with. What they just announced was actually their 3rd quarter. That's right. We can see that their accounts receivable amount has indeed gone up. That's correct. But let's use a simple pen here to help everyone get a feel for it. Below, we have the QOQ, quarter-on-quarter figures. This is the quarter-on-quarter change in accounts receivable. We didn't really look at the year-on-year change, just the quarterly one. Next, let's look at their revenue and the QOQ for revenue as well. If we take a look, the changes in accounts receivable fluctuate, sometimes higher, sometimes lower, but you can generally see that it roughly follows the trend of their sales. That is, it moves in line with their revenue. The pattern of these changes is still quite noticeable. We can clearly see the so-called credit sales ratio, which is accounts receivable divided by sales. You can see that it generally stays at a certain level, fluctuating up and down. Later on, it does go up, but the question is, why do you need to look at revenue together with AR before this? For example, in the fourth quarter of 2024, their accounts receivable revenue was only $22.1 billion, but now it's $57 billion. Oh, that's extremely rapid growth. So you might ask, during this growth process, accounts receivable has increased, I think, in terms of proportion, with a credit sales ratio of about 58%. This number should still be within an acceptable range. Also, we directly found their accounts receivable turnover rate above. Roughly, we've included it here. So what we do is a back calculation using 365 days in a year to reverse calculate the turnover rate and figure out the accounts receivable turnover days. You get the number shown below. In the early days, when revenue was relatively low, the turnover was pretty fast, just over 40 days to complete a cycle. But as we get closer to the present, in the most recent few quarters, it's been around 46.3 and 49.8 days. If you really take a closer look at these turnover days, you'd think they're actually quite reasonable. It takes less than 2 months to turn over the receivables, which I think is pretty good. Of course, you can't really compare this industry to the ones we're more familiar with in Taiwan, so we just look at its own historical development. In that context, I think these numbers are quite decent. In theory, there really aren't any big surprises here. Of course, you could question them, like the market does, and ask why their accounts receivable ratio has still increased so much. But we have to remember, after all, this is a high-growth industry. The second point is about their top 10 customers, especially the main clients among them. U.S. financial reports don't require you to disclose a detailed list of clients. But there is a rule. If a single client accounts for more than 10%, you can refer to them as Client A, Client B, and so on to indicate who they are without revealing their actual names. So basically, we can make some educated guesses based on what's being speculated out there. This was mentioned yesterday. NVIDIA's percentage, I think, is over 40% for a single client. Or was it over 60%? There was a ratio mentioned yesterday. You can check the numbers from yesterday. Roughly speaking, this portion is delivered to the 4 major CSP companies. So at the very least, this is not a small proportion. These sales are going to those giant companies. That's basically what you might want to know. So there's no need to worry too much about that. In addition, they've also signed some national-level data center deals. For example, if they have a sales deal with Saudi Arabia's Humane, do you think there's any reason to worry about bad debt with this kind of sales amount? All right, of course, there are some small companies that do have these issues, but it's the same thing, right? So when you're doing business and offering credit, there's always this kind of risk. So what do we have to do? As long as you trust their management capabilities, that's what matters. There are a lot of cases like this in Taiwan too. Take Apple, for example. Well, Apple is a bit different. Most of their stores are directly operated, or they give products to certain distributors and channels. You also have to look at the situation with those channels to see if there's a risk of them taking the goods and not paying. There are always some situations where people take the goods but don't pay for them. This kind of risk is always there. We're living in a credit-based society now, and it's just not realistic to expect everyone to pay in full before getting the goods. So let's first look at accounts receivable, okay? All right, next, of course, we still have to be very responsible, so let's take a look at the inventory and see what the situation is with the inventory. So, as for the inventory amount here, I think it's still basically following the trend of their revenue going up. For example, the quarter-on-quarter amount of their inventory. It's actually a bit more. Honestly, if you want to talk about problems, I think the speed at which inventory is increasing is actually faster than AR. The AR part still looks relatively reasonable, of course. If you really want to point out an issue, it might be that inventory is a bit high, but the thing is, after you stock up on inventory, you still need to ship it out, right? So let's take a look at why that is. The proportion of inventory to revenue is about 35%. On the far right, by the third quarter, is 35%. I think this number is increasing, but it's still relatively good. Why do I say that? Mainly because you still have to look at the inventory turnover days. Previously, the turnover was actually a bit higher. Now, looking at the most recent few periods, you can see that the inventory turnover days have actually come back down to below 90 days. In other words, it takes less than 3 months for all your inventory to turn over once. Is this really a big problem? I think, looking at it from this side, it actually seems okay. Of course, we haven't really looked into the payables side because my immediate reaction when we get to this point is to check the cash flow. I just want to see if there's any issue with the cash flow. After checking the cash flow, I feel even more certain that there probably isn't a big problem. Why? Well, it's pretty straightforward for us. We just focus on this summary section. The first part is cash flow from operating activities. You can see that the cash flow from operating activities is a very large amount, while it's actually the investing activities that stand out. Okay, so this refers to their external investment activities. This part is consistently going outwards. If you look at the strategy mentioned in the China Resources presentation, as long as it's an excellent AI model, they want to invest in it. That's how they put it. So I think this is something you just have to respect. Now, if you look here, I think the cash flow from investing activities is still okay, but we also need to look at the cash flow from financing activities. This cash flow from financing activities, well, actually it's cash flow, sorry, it should be cash flow. Here, we need to talk about something. You can see that this part is negative, so I discussed with my colleagues what this means. It means that after making a profit, they're using it to pay back their loans. So I think this is a matter of financial security. If they have the ability to pay back their loans, then overall, then, in terms of cash flow, the level of security should be quite high. Otherwise, they wouldn't be able to use it to pay back loans. Why is that? Because if they really weren't making that much money, they'd keep the cash for operating turnover or to pay some interest. Getting this revolving credit line, that's probably how it works. So when you look at the cash flow later on, especially the free cash flow here, it also looks pretty good. That's why I'm telling everyone, when it comes to this financial report, it's the same. There's no such thing as a perfect financial report, and there's no absolutely risk-free lending, right? There's no such thing as a completely safe business. If you really want absolute safety, then only government bonds are truly safe. There's really only one thing that's the safest, and that's not just here. It's pretty much the same everywhere in the world, which is within the limits allowed by deposit insurance. You can put your money in a fixed deposit, one person, 3 million, right? In Taiwan, I think it's still 3 million, or maybe 300,000. I forget. But anyway, there's a cap. You can invest and get that 1 or 2% interest, and that's the safest. But the problem is you won't be satisfied with that kind of return, right? It's the same with running a business. There's always a certain level of risk. There's always a certain amount of risk involved. But at the same time, we shouldn't just reject these kinds of doubts. Why do you only see the good side and not consider the possibility that something could go wrong? That's actually the real issue. Having doubts is what helps you go further. So we believe in this. I think if you look at it from this perspective, when someone points out an issue, you should take a look and clarify things. After that, everyone can see the numbers. If you want, you can download them from our Dallioing platform and check them out. Take a look at these numbers. I think after seeing them, it's pretty clear. Personally, I think it's still pretty okay. There are some points that can be questioned, and that's reasonable, but the response itself also makes sense. So honestly, this is something where people might have different opinions. So let's get back to the question. You still have to bear the short-term impact. I think that's about it for this question. Maybe everyone can go back and reflect on it a bit more. I think that's pretty much the number in my opinion. Everyone can think about it for a bit. I think the number that comes out should be similar to the conclusion I reached. All right, next, let's take a look. But the atmosphere yesterday wasn't very good. Like I said, you still have to bear the short-term impact. Here, let me add another part. Yesterday, I mentioned something about fat on top, thin on the bottom, right? That's the first point. So hard is fat, soft is thin. The first is fat on top, thin on the bottom, and then big fat, small thin. That means hardware seems to have more advantages than software. Upstream is more advantageous than downstream, and large companies have more advantages than small ones. But yesterday, we also saw something else. It's actually something that kind of slapped us in the face, but I think we need to pay attention to this. What does this reflect? It might reflect a change in the market's risk appetite. The main thing is, why do we see SK Hynix in Korea and Micron in the US? Why are we only focusing on these two? Because we're talking about DRAM, and these two are the top players. Why are we only talking about these two companies? The main reason is, because when it comes to DRAM, Samsung is mainly, well, Korea has two companies, Samsung and SK Hynix, and then there's Micron in the US. So why aren't we talking about Samsung? It's because Samsung's business is too diversified. Its focus is too scattered. You can't really see its true performance in DRAM unless they specifically disclose it. Its proportion and then its stock price are affected by other factors. So when we look at Samsung, we use SK Hynix and Micron as examples to explain things. Sometimes we see that analysts all have a positive outlook. On the 20th, it was KB Securities from Korea. Now, we should mention that we don't know whether it was released in the morning or afternoon on the 20th. So we've been watching its performance on both the 20th and the 21st. Also, UBS has maintained a buy rating on Micron and has raised its target price. However, due to regulations, we can't disclose the target price to everyone. We can only tell you that it's a buy and the target price was raised. But we need to look at this week's performance. SK Hynix went up on Monday, but then fell on Tuesday, Wednesday, Thursday, and Friday, with today's drop being especially steep. This reflects the changes in the U.S. stock market last night. But looking at Micron, on Monday it dropped nearly 2%. On Tuesday it fell more than 5%. On Wednesday it was down over 1%. And yesterday it plunged almost 11%. Even after hours it continued to fall. What am I trying to say? Now we can see that some of the strong individual stocks are under some correction pressure. So that's why I mentioned earlier that you still have to bear with the short-term shocks. This is something we probably have to face and make some adjustments for. Okay, so I want to explain this part to everyone. Now, before we move on to the second topic, let's take a look at the corporate earnings reports announced yesterday. Yesterday, we mentioned that Walmart's earnings report was especially good, so its revenue and profits were very strong. And it even raised its revenue outlook for this quarter and for this fiscal year. So financially, this is... After hours, the stock closed up by about 6.46%. Wow, that's actually a pretty good performance, probably the best one. If I remember correctly, it was the leading stock either in the Dow Jones or the S&P. Okay, and then the others didn't do so well. For example, Basic Basin's Bodywork, that's basically bath and home products, didn't meet revenue and operating expectations. Management said that the transformation will take time, so it's basically a total flop for now, and the stock plummeted nearly 25%. Also, in the engineering services sector, Jacob Solutions saw both revenue and earnings drop by almost 11%. Warner Music, its revenue was better than expected, but its earnings fell short of expectations, so the stock also dropped. What we saw yesterday is that the earnings reports are very faithfully reflecting the actual performance for the quarter. If the outlook for the next quarter is good, the stock holds up. If not, it just goes straight down. Also, after the market closed yesterday, the discount apparel retailers performed relatively well. The commentary was similar to that of their peer, TJ Maxx, so their inventory situation is about the same. At one point, it was up by 4.6%. When I say at one point, I mean it reached a 4.6% increase, but later, by the close, it returned to the closing price. Of course, this is just the after-hours part. You still have to see how the main market performs when it opens today. Also, there's another company in the software sector. It's actually a company that makes tax software for the U.S. In addition to that, they mentioned that they're planning to integrate AI, specifically by developing AI-driven financial management tools. It seems like the market responded pretty positively to this. So this part actually exceeded expectations. And after hours, the stock was up nearly 4% at one point. The same goes for Gap as well. The numbers for the third quarter were better than expected. Also, they mentioned that low-income consumers are still spending, which gave the market a bit more confidence. That's why the stock went up after hours. And just to add a little fun fact about Gap here, it operates different brands, and mainly Gap is considered a mid-priced product in the U.S. The brand more popular among office workers is called Banana Republic, while the more affordable one is Old Navy. Old Navy's prices are lower, and there have been reports saying this segment performed well. But on the other hand, Banana Republic's revenue actually exceeded expectations. In fact, Banana Republic and Old Navy performed better. It's basically a mixed reaction, one up, one down. This is what people call a K-shaped economy. That's pretty much the situation. Now, moving on, Vera, this company makes life science instruments, so it's related to medical equipment. What's surprising is that their earnings report was good, and their financial outlook was also raised. But unexpectedly, after hours, the stock dropped over 6.6%. The AI search engine company had higher than expected losses, so its stock fell almost 11% after hours. The auto service provider's numbers were poor, so its stock at one point fell 3.5% after hours. So when we talk about market changes, today let's first finish discussing the economic data and the Fed's latest moves, and then we'll look at them together, okay? Because actually, yesterday, these were all interconnected. Mainly yesterday at the end, toward the end of the show, we took a look at these numbers together. At first glance, I thought they looked pretty good, but then actually the market's interpretation was a bit mixed, more divided between bullish and bearish, with positions not so consistent. So first, let's talk about the non-farm payroll numbers. It was indeed better than expected, but the revisions for the previous 2 months, well, the previous month was minus 4,000, right? The 2-month cumulative revision is minus 33,000, so that's 33,000 fewer people. That's actually quite a significant change. But if you look at the 3-month moving average, you'll see it's been boosted to 119,000, so the trend is upward. All right, so the unemployment rate has reached 4.4. Now, some people in the market are a bit pessimistic about this unemployment rate, but the thing is, let me tell you, going from 4.3 to 4.4 actually it's really not that great, so I want to talk about this. I personally think this jobs report isn't too bad, but the problem is the general conclusion the market has come to after looking at it is that this outdated jobs report probably can't provide much of a definitive answer for whether the Fed will pause or continue with rate cuts, because this is basically... Yes, this is data from September, and now there's a gap of 2 months, October and November, so it's a bit old. Plus, September was before the U.S. government shut down. But we'll look at some details in a moment, and there are some comments from everyone. I think basically, maybe just use this as a reference. The impact is probably more obvious when it comes to the Fed's interest rate decisions. Also, there's another point mentioned. UN officials probably won't be too affected by this because, well, many UN officials are believed to be against another rate cut in December. We'll keep watching this part as well. The main issue with this jobs report is that the scope of job growth is very narrow. It's mostly concentrated in healthcare, entertainment, and hospitality, so entertainment and hotels. Basically, that's how it is. Healthcare is mainly within the so-called special services sector, which is a bit more unique. Okay, but within that, there are some positions like caregivers and those working in related fields that have seen some growth. However, the problem is that entertainment and hospitality are basically considered low-wage service industries, so that's not great. Meanwhile, manufacturing, transportation, warehousing, and business services are all seeing job losses, which is a weak point, especially in manufacturing where the losses are significant. I think the market is still pretty concerned about this because, after all, Trump's various policies have all aimed to bring manufacturing jobs back. But as we can see here, the number of people employed in that sector hasn't actually increased. So in this report, the general environment is basically saying this. Previously, it was a no hiring, no firing situation, meaning companies weren't laying people off, but they also weren't hiring because it was hard to find good people. But now that environment has been replaced by layoffs. So before, no firing, no hiring meant there weren't good candidates and companies weren't hiring. That atmosphere no longer exists. The bigger issue we're seeing now is, the main issue is that the scale of layoffs is pretty big. This has made American consumers, that is, the general public, more worried about employment. Also, there's another point. A researcher from EY Parthenon mentioned that before the market opened, they noticed a rather unfavorable situation, which is that jobs are too concentrated in a certain specific field or few fields, which makes the situation feel more vulnerable. In addition, the report also mentions, this is also about the September report, that at the FNC meeting on October 10th and December 10th, the only official employment data they had on hand was this one, because the numbers for October and November wouldn't be released until December 16th. Even if they had some internal references, for the most part, they still have to rely on the final data officially published by the statistical agency. That's why. So with that being confirmed, Boomer here believes that the probability of keeping interest rates unchanged is rising. I think we'll see that interest rate trend chart in a bit, and I feel like this is gradually taking shape. And then there's a really confusing number here. This is where I say things get messy. Yesterday, it was supposed to be the release of the unemployment claims, but when they announced it, they didn't just release one number, they released several. One set of numbers is from before the shutdown, around September 27th, and then the continuing claims from the 20th. Generally, continuing claims are reported about a week later than initial claims. You can see these numbers being released all the way up to November. Honestly, when these numbers came out, I was really shocked after seeing them. I had to take a moment to process it. Okay, so let me talk about one thing here. Let's first look at the initial claims, which fluctuate between about 220,000 and 230,000 people. Now, what's interesting is the continuing claims. As we'll see in a moment, they start at around 1.92 million and go up to about 1.95 or 1.96 million. Over several weeks, you can see that by the end, it drops to about 1.74 million. So this shows a pretty significant increase, and that's something we need to talk about. This part, it seems that given the uncertain economic outlook, employers are generally trying their best to retain their current employees. This somewhat contradicts the September employment report, but the key point here is that employers are still doing their best to avoid large-scale layoffs. That's basically what you can see from this. Looking at the number of people receiving severance pay, you can see it here. That's what you can observe. Of course, in the employment report, you see that layoffs are a bit higher there. Now, let's look at another point here. I need to mention something that people are less satisfied with in this data series. That is, while the initial jobless claims are relatively low, it's true, you can see they've dropped back down to the 220,000 to 230,000 range. But the issue is, what about the number of people continuing to claim unemployment benefits? That number has hit a new high for this cycle this week. This is the part that people are more concerned about. The negative aspect here, but I want to point out something. It's actually quite paradoxical. Clearly, the initial claims haven't increased significantly, and while your initial claims haven't surged, but for continued claims, you can only file for them after your initial claim, after you file for the first time. If you still haven't found a job and keep claiming, that's what counts as a continued claim. But the number of people making initial claims isn't that high. The number of people continuing to claim is still going up. I find this a bit questionable, but at the same time, we have to say that these numbers are, well, they're compiled at the state level and then released as a single report. I think actually the number of people applying for unemployment benefits often gets significantly revised week to week. Many times when there are holidays or other factors, there are big adjustments. I expect that these numbers will be revised later, so I just wanted to add that for everyone here. As for the other data, looking at it, there are two manufacturing indices. Philadelphia's is below expectations, but it's a significant improvement compared to the previous period, but still not as good as expected. As for the Kansas index, it's better than expected and also better than the previous period. So that's one good and one bad. In addition, existing home sales actually showed a surprising result. I think it was quite unexpected with a significant increase. The main point is that while some home buyers took advantage of the lower mortgage rates since rates were relatively low before, so some people went in to buy houses, to buy existing homes. And now it seems like sellers are less insistent on price. You can see that there have been more transactions in the existing home market. The difference between existing homes and new homes is that new homes require a building permit before they can be sold as new homes. So the numbers for new homes are delayed and can only be released by the government, but the data for existing home sales comes from private industry associations. So these numbers aren't affected by the government shutdown. So in addition, tonight's main data release is the preliminary figure for the S&P PMI. Of course, this preliminary figure isn't as important for the US because Americans prefer to look at the set of data released at the beginning of each month, either on the 1st, the 3rd, or whenever, mainly the ISM manufacturing and services indices. When it comes to salary adjustments, Americans like to see the numbers they've compiled themselves. It's an original index. In fact, the S&P is also pretty much their own creation, but they just consider the ISM to be the real deal. So just keep that in mind. Also, later tonight, the Michigan Consumer Sentiment Index will be released. Since this is the mid-month reading, as long as it doesn't differ too much from the preliminary figure, I don't think it'll cause any major issues. In addition, there are also some city-level numbers being released, called short-term sales and short-term inventory. The impact of these might be a bit smaller, but people will say the data's very messy. Yeah, the data's quite messy. Actually, there's another part. Yesterday, Actually, I mentioned to everyone that there was supposed to be a big announcement of some data. This is the part that he said yesterday he would release, but in the end, he didn't. So when you see 2120, will this be released today? Honestly, we still don't know. He hasn't given a definite time, only saying that it might be released today. This includes new project starts and construction permits, and then advanced goods trade balance, right. Retail inventories should generally move in line with the goods trade balance. Well, you mentioned inventories. Okay, there's also the new home sales figure. And then this one is separate, which is the monthly fiscal budget report from the 21st to the 25th, of course. This is also... It's possible that these numbers will be revised. So right now, the data is still being updated, so please bear with it. The numbers might fluctuate a lot, and one day they might suddenly change by a lot, so everyone just needs to be a bit patient. Next, let's look at the comments from Federal Reserve officials. Yesterday, the first thing was... Actually, I'm going to talk about this more or less in chronological order. The first one is Houndmac. As for Houndmac, he was actually more hawkish than expected. Even though he comes from Goldman Sachs, I originally thought, before he was nominated, I thought he would be more in line with the market, but later, from his statements, I realized he was actually very hawkish. So he really emphasized that if we cut rates now just to support the labor market, it could actually push inflation even higher for longer. And because rate cuts encourage speculation, it increases financial stability risks. So his remarks were extremely hawkish. Then, yesterday, someone mentioned, wait, we'll get to Governor Barr in a moment. Governor Barr also tends to be more cautious in his thinking. He said, inflation is about 1% above the target, so it's around 3, while the target is about 2. In this situation, we need to be cautious about cutting rates. Actually, compared to the others, Barr's comments were relatively mild, but still. The two of them spoke a bit earlier. So here, after these two started talking, the market began to react to the situation from the previous day and the release of the jobs report. People started to think that the expectation for a rate cut in September or December was decreasing. That is, the likelihood of a rate cut was going down. In addition, Liz Cook also spoke, but only talked about regulation and did not mention monetary policy. As for Chicago's Goolsbee, he also made rather conservative remarks, saying that he would remain cautious about further rate cuts. So that's another factor added to the mix. Next, as for the speeches by POS and Mirren, both of them actually spoke after the market closed. So regarding these two, POS is a woman who just took office in July, and she also expressed a rather cautious attitude. As for Mirren, of course, she was nominated by Trump and is someone close to him, so naturally she continues to hold those preferences. He said that interest rates should be adjusted to approach a neutral level. So in his view, that means getting close to about 2. But actually, the Fed considers close to 3, at least close to 3, or even just below 3. Of course, among the officials, I think there are still a bit more people who oppose this view. And then yesterday's, the Labor Fund advisor is still speaking out. He said that if he were the Fed chair, he would act now, and he believes the data shows that this is what we should do. To be honest, when I look at that data, well, I can only say, His data should basically be called Donald Trump, so that's pretty much his take on it. All I can say is he's expressed his stance many times. Almost every time he speaks, people ask if he would be the Fed chair, and he doesn't hide it at all. He says he wouldn't mind, but I think if he really does get appointed as the Fed chair, I think everyone will have to... People will have to start thinking about things from a different perspective. So let's just wait and see. If he really does get confirmed, then we can talk about it more. Alright, moving on. On Friday, there are still some Fed officials scheduled to speak. There are quite a few tonight, actually. First, on the left here, we see at 8:30, John Williams from New York is scheduled to speak. He's the second one on the list. Then at 9 o'clock, it's Boston's Collins. At 7:30 p.m., it's Barr from the board. Then at 9:45, it's Vice Chair Jefferson. And at 10 o'clock, it's Logan from Dallas. Did y'all notice that, in theory, all these speeches are scheduled to start before the market opens? Whether they'll actually finish before the opening, we don't know, but the speeches are basically before the market opens, so maybe the impact on the market won't be as big as it was yesterday. Also, November 23rd, which is next Thursday, is Thanksgiving. Then, from November 29th to December 10th, that's what's called the blackout period, when officials are not supposed to speak publicly, or if they do, they can't talk about monetary policy. But the thing is, well, the 28th is Thanksgiving, and Friday is a Good Friday. Usually, after the 27th, basically from the 26th, no one in the US really wants to work anymore. So the work atmosphere will be a bit more laid back the week after next. We'll see if anyone comes out to make any statements, but I think the peak will probably be this Friday, or at most until next Monday or Tuesday. That's about the busiest it'll get. On another note, we were discussing with colleagues today and someone came up with an idea. If there's no rate cut on December 10th, will Trump start making a fuss and maybe even take the opportunity to announce his pick for the new Fed chair, the one he thinks will actually cut rates? Let's wait and see. It should be interesting. Well, I'm not sure if that's actually going to happen. My shift in December is during the last week, so by then we might already know if this situation is played out. Well, just have to wait and see. Also, before we look at the markets, I want to quickly share a few more news updates with everyone. So the US announced that there's been an increase in sales to China, and it's been confirmed that China has purchased wheat. This is considered good news. But just to add a bit of gossip here, this was announced by the USDA. I heard this from a grain blogger, actually a YouTuber who was commenting on it. This person is a foreigner and was speaking in English. They were saying, well, it looks pretty good that you've made a purchase, but the real question is whether the goods are actually shipped, because they have a closer relationship with soybean farmers. They basically serve the soybean farming community, these YouTubers. So they said, yes, you did make a purchase, but it only really counts if the goods are shipped, since the farmers are looking at the soybeans sitting in their warehouses. It's not just about storage costs, it's also about interest costs and such. What they really want is for the goods to be shipped out. That's what gives them peace of mind. So that's another point they added. However, the U.S. Department of Agriculture has announced these sales, so people can keep an eye on that. At least in terms of the atmosphere between the U.S. and China, I think things should be better now. Also, there was some news yesterday about the situation with the truck drivers, and the White House has put forward a new peace proposal. The latest update before we went live is Zelensky, along with European Union allies, has officially rejected this peace proposal. So, unfortunately, if they really do reject it, you can probably expect Russia to launch a winter offensive. This winter offensive is probably going to be pretty bloody. So if you really don't like war, you might as well not pay attention to it. Also, on another note, on Thursday, China's customs announced that rare earth exports to the U.S. have increased, rising to 656 tons, the highest level since January. So it looks like, on this front, China is probably making moves to satisfy Trump, addressing his concerns. They've bought agricultural products and sold rare earths, which is probably a good thing. So I think at least in this area, Trump should be pretty happy. Right now, he's still mainly focused on domestic affairs, but yesterday there was some not-so-great news. The U.S. Congressional Budget Office downgraded Trump's tax revenue projections. $111 trillion. Originally, long-term tax revenue was expected to reach $4 trillion, but it's been revised down to $3 trillion. That's not great. Mainly it's bad news for bonds. Of course, the bond market has been reflecting this volatility over the past few days, so yields haven't really jumped. But the issue is, you need to realize that the demand for issuing new debt will be much higher going forward. With tax revenue decreasing, 9 times 9 is the fiscal deficit that needs to be filled. You want them to tighten their belts. Americans need to tighten their belts, but that's easier said than done. So just keep this in mind. This could be a factor that leads to rising interest rates in the future. Whether it's a driving force or just an excuse. Okay, next, let's take a look at the market from yesterday. Wow, yesterday we specifically put up the futures for the S&P small cap stocks. Why did we do that? Because yesterday the real action was happening right there, and we had to focus on that. Let's take a quick look. Basically, after the US stock market opened at 8:30, we really needed to pay attention to the spot market before the open. That was still referring to the point around 8:30. When we were looking before the market opened, 10 o'clock US time, the timing might need to be adjusted a bit. Anyway, roughly before the market opened, what we saw was Yesterday, at the end of the show, we saw that the market was moving upward. There wasn't any sudden reversal right after the open. It wasn't until around 10 or 12 o'clock that things started to weaken a bit. The main reason we pay attention to 9:30 is because that's when the market opens and when the employment report and jobless claims numbers are released. But actually, after the main board data was released, it didn't really affect the main market's opening. There were also speeches from Barr and from the Cleveland Fed's Mester. I think, honestly, they weren't really all that harsh. Yes, they were hawkish, but it was the kind of hawkishness everyone was expecting. So at noon, actually, Cook didn't really say much, and even at 1:40 when Goolsby spoke, it wasn't all that intense either. The main thing is, you can see that what really reversed the market sentiment were the speeches from Cleveland's Mester and Barr. Now, since we're talking about these speeches, let's first talk about who was speaking. If you look it up in the official schedule, he might have told the media when he was expected to speak. But you have to understand, just because it's his speaking time doesn't mean the market will immediately plunge as soon as he opens his mouth. Why? Because he might start with some general remarks, and it's only after he gets to a certain point in his speech that his real intentions come through. So it's only when he brings in the main points of his speech that things really start to happen. So even if he starts talking, you can't say the market will crash the moment he opens his mouth. It's not that harsh. Unless it's something like when Trump launched a trade war and imposed reciprocal tariffs, that kind of situation. Most of the time, the main course only gets served after things have already started. So if you look here, actually, from 9:40, sorry, the timing's a bit off. Sorry, I got it wrong. It should be Cleveland at 9:40 first, then the bar at 10:30. Okay, so looking at it here, yesterday the market was mainly affected by a big change related to interest rate decisions. As for concerns about Nvidia, I think those were there too, but at least in the early session, people didn't seem to feel it was a big issue. Later on, though, things corrected. So let's first take a look at what's important. Let's check it out. So about the expectation of a rate cut. For December, the rate cut is now expected to be just half a point. What we're seeing here is the rate cut probability, which means it's half a point. So yeah, this is less than a full point cut. I think this basically tells you that the market still sees it as a 50-50 chance. You can pretty much interpret it as a 50-50 chance of a rate cut. But what I want to say is, with the way the economic data and the officials' attitudes are shaping up, I personally think it's quite possible that there won't be a rate cut in December. But what we want to talk about is the possibility of a rate cut after January. Specifically, we've listed out January, March, April, and June. Why up to June? Because in June, there will be a new chairperson, and what happens after that? With this kind of expectation, at the very least, we have to wait until the new chairperson is selected. Only after they start speaking will we know what to expect. Now, looking at the period after Powell steps down, his term ends in May, so for June, we can see that in January, there's still about a quarter-point rate cut expected. As for March, it's about 1.5 rate cuts, meaning it might be a bit more than a quarter point, but not quite 2. By April, it's getting closer to 2 rate cuts. So looking at this, there's still a chance for a rate cut in January, but the expectations for further cuts aren't particularly high. Why? First, there's a lack of economic data right now. Second, the official stance is relatively cautious. The third reason is that the new Federal Reserve chair, who might be more dovish, hasn't been appointed yet, so everyone still has their own opinions. So looking at this, by April, we still haven't quite reached or exceeded 2 rate cuts, but by June, there's still more than 2.5 rate cuts expected. In other words, this also means that there's a chance for another rate cut in January next year, and possibly more between April and June. But the scale of these rate cuts is clearly not as much as what Trump expected. So, as I mentioned earlier, it really depends on who the new Fed chair will be and how the economic data changes. Only then will we see if these rate cut expectations will be adjusted. At the very least, what we want to point out here is that, based on the number of rate cuts implied by the federal funds futures, it's possible there won't be a rate cut in December, but if you ask about the chances of a rate cut in December, it's about 50-50. The thing is, there could still be a cut in January, and then another one between April and June next year. So overall, the rate cuts haven't really materialized yet. Completely disappeared, right? It's just that if the rate cuts aren't significant, then the support for the prices of various financial assets will be greatly reduced. Okay, now let's take a look at how the market performed yesterday. Wow, the S&P 500 was basically It's a pity. You see, it went up, and the situation we saw in the early session yesterday was actually pretty good, but the problem was, by the end of the session, things took a turn for the worse. The drop was only 1.56%, but if you look at that candlestick, it's really huge. This is going to take a lot of time and energy to work through and digest before it can be resolved, so that's not really a good sign. So, after yesterday's big drop, the downward space we originally expected, like we said, the correction in terms of both space and time, it looks like the space for a drop might have gotten even bigger. And as for the time, it's still relatively long, so everyone should keep that in mind. The volatility index jumped yesterday, and it's still rising today. So hopefully, if we look at the futures later and see some improvement, maybe there's a chance the decline could narrow. Also, as I just mentioned, Walmart and the S&P are leading the gains, mainly because their earnings reports are better. The other two are probably related to healthcare. So looking at the overall situation, on the other hand, what's not so good is Jacob & Co.'s earnings report wasn't very good. As for Micron, I think it's just that it had already gone up a lot. Then there's Robinhood. I'm not sure if they've released their earnings report, but it's also pretty weak, with a significant drop. And what surprised everyone was CrowdStrike's big plunge. The drop was really steep, and the candlestick chart looks really ugly. So CrowdStrike's performance wasn't particularly good. As for the Dow Jones, it's also pretty weak. Same thing, a huge, massive bearish candlestick. It'll take some time and effort to digest this. Over here, it's the same. If we look at the Dow Jones, the leading stock by points is still Walmart, followed by United Health. So insurance is still leading the gains. The weaker ones are Goldman Sachs and Microsoft. On the other hand, let's take a look at the Nasdaq. It's the same story here, very similar. What's more important is the Philadelphia Semiconductor Index, SOX. It plunged 4.77%. None of the component stocks went up, they all fell. Micron dropped the most, and AMD also fell by 7.8%, and Teradyne as well. Semiconductor equipment stocks also dropped by 7.33%. TSMC's ADR fell by 1.72% as well. Again, none of the Magnificent Seven stocks went up, most of them saw significant declines. Now, we still need to take a look at individual stocks. Please check them out for yourselves. Due to certain regulatory restrictions, we have to be a bit cautious here, so we won't be reviewing the performance of specific stocks. But just keep in mind, if a stock's technical chart looks weak, you really need to wait for it to bottom out before there's any opportunity. If possible, try to stick with the stronger stocks and let go of the weaker ones. This applies to the index as well. As for the US dollar, it looks like after a big jump yesterday, there was a slight drop. The key point is that the dollar seems to have held its ground. First, it has truly broken through the downward trend line, and second, it's aiming for the significant $100 mark. It has held steady, and right now, the market consensus for a rate cut in December hasn't fully formed yet. Although I personally expect that there will be a pause in December, I think the likelihood of rate cuts later on will gradually increase. As more economic data is released, I believe that in the short term, the job market will remain relatively weak, and prices probably won't rise significantly. Because looking ahead, there are some signs. Tariff exemptions or some tariff relaxations are being put in place, so prices may not be that high, which means there is still a possibility of continued rate cuts. Also, the 2-year yield here is still relatively weak, so the expectation of rate cuts hasn't been affected. That would normally have an impact, but the problem is that the stock market is plunging, so there's a demand for safe haven assets. That's why both the 2-year and 10-year bonds are going down. Now let's take a look at the next part. Switching over to the live section here, let's take a look. Looking over here. Here the futures have just turned positive before the market opens, which is good, but we already learned our lesson yesterday. Everyone, please look at the main market. Don't just look at the opening. Pay attention to the closing as well. There's really nothing we can do. The futures look better, but why am I still being cautious? Because I saw this before the market opened. There weren't that many stocks accelerating upward before the market opened. This information actually came in closer to the opening bell, so things looked a bit better here. As for NRG, it dropped the previous day, but today it's rebounding. IMTU just went soft right away. Ross Stores, everyone's talking about it. The earnings report was pretty good. Also, looking at Google yesterday, it seemed relatively weak, but now there's a bit of a rebound going on, and we did see some upward movement. As for the stocks that were dropping, when I checked this morning before the market opened, these were the weaker ones. Previously, if you looked around 8 o'clock, there were more stocks dropping over 1%. But now, as we get closer to the market open, this is the situation. There are actually more stocks going up now, so there's been a bit of a reversal. Maybe that's what's driving the futures in the index. So it's shifted to being a part that's going up, but I want to remind everyone, let's go back to the technical side. The drop was just way too big, so you need to keep that in mind. A rebound today might be a good thing, but the problem is, to really offset that huge long red candlestick, it's going to take time and room to work through it. Now, let's also take a quick look. Today, regarding the OTC and emerging stock markets, I checked before the market opened and didn't see any particularly important companies, so we want to talk about those. The main thing is, let's focus on this. Economic data. Right now, it looks like only the average hourly wage has been released, which isn't very significant. So later on, there probably won't be much in terms of fund data to share. For today, let's prioritize answering everyone's questions. So, hello everyone. The Japanese yen. Oh, someone asked about the yen. Okay, let's talk about the yen. Let's take a quick look, okay? Yeah, let me just take a quick look for everyone. You're probably asking whether the yen will stay in the 150 to 155 or 160 range, right? I think good. All right. Yesterday, Katayama Kogetsu, well, this morning, Katayama Kogetsu, the Japanese finance minister. So in Japan, the exchange rate isn't managed by the central bank, it's managed by the finance minister. And the finance minister has said not to intervene or anything like that, so he has actually moved to appreciate the yen. But the problem is whether the market believes, like in December or maybe in January next year, whether the Bank of Japan will raise interest rates. If they don't raise rates, I think the yen probably won't get much stronger. All right. And as for whether it could get even weaker, I think that's also possible. The extent is limited. Also, today, Sene Takaichi announced her fiscal stimulus plan, and the amount is quite large. But the problem is, this is also something I want to mention Abe's 3 arrows. Maybe it's like the 3 arrows. Takaichi's 3 arrows might not really be 3 arrows. Maybe it's more like breaking the arrows. Now, it's not that I look down on this approach. It's not about looking down on it, but rather you have to consider that when Abe implemented the 3 arrows, Japan's economic environment was quite different from what it is now. Not just the economy, but also fiscal and monetary policies. These are all different now. Can high performance really be pushed through? I don't know. I'm actually pretty skeptical about this. It's not about his personal ability or energy, but rather that the current environment might not allow him to push it through. So we'll have to wait and see. As for Japan, to be honest, we still mainly focus on the US dollar, US stocks, and US bonds. I probably won't get involved in that market. Well, we've talked about this quite a bit, so next, let's take a look. If we don't have this, if there are no other questions, then we'll wrap up here for today. The main thing to note is that the futures have turned positive. Wow! So sentiment might be a bit better. Also, for individual stocks, the number of stocks rising in pre-market trading is clearly much better than what I saw before 8 o'clock, before I started the live stream at 9. Previously, there were more stocks falling in pre-market trading around 8, but now that's turned around. Still, let's talk about this. The big black candlestick from yesterday, Thursday, was really significant. It'll take time to gradually work through this. Honestly, it's hard to see a quick turnaround. Don't expect a so-called V-shaped rebound. That's probably too optimistic. Instead, we should watch as things slowly get digested, and this kind of market tends to last longer. As for Nvidia, we also looked at part of their financial report. There are some aspects that could be questioned, but I don't think the situation is that bad. So the market's concerns aren't as bad as people think. That's what I wanted to share with everyone. If there are no other questions, we'll wrap up today's live stream here. See you all next week.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.